this market has seen a decrease. Not only have they seen a decrease, but the new supply that is under construction, so we know it will be coming, is very large. We're in a market cycle, everybody, that we're going back to normal. We didn't used to be able to just buy anywhere, and rates everywhere went up and occupancy went up. They were subject to natural market forces, and individual markets acted individually. That's where we're returning now. Welcome everybody to Self-Storage Income. And it is now, we're done with the long weekend, Memorial Day weekend. Hope you had a good time.
Oh man, I got some sun. It was good, and hung out with the family. Really took some time to appreciate it, Can't say enough about all the foundations that have been laid for this incredible country that we live in. Couldn't be more grateful and appreciative of those things, and hope everybody was able to take a step back and appreciate it as much as I did. And hopefully you guys did as well. Got some freedom in.
We did. That's right, we did. Got swimming and
that's awesome.
The kids out, and amazing the opportunities that we have and able to relax and the things that we have due to the sacrifice of others. Always important to remember that. So
truly is.
Good. It was a good weekend. It's interesting as we move into spring, looking at rates across the markets, seeing what's going on across the United States, because we're moving into the busy season. And we have some Yardi Matrix reports that have come out, closed out here now for May, and had some interesting data and things we want to hit on and talk about, and what it means and what it means for you and what you can do with this data. So I think giving it kind of an overview, we can start out with there, and we can kind of dive into some of these things. So year over year rates fall across all top metros. So street rates continued to decline on an annual basis in April. National average annualized same store asking price rent per square foot was $16.35 for a combination mix of units and size types. This is a 4.5% same store decrease when compared to April of 2023. However, it is a 70-point basis improvement month over month as the busy season progresses. So we're starting month over month, we're starting to go here, and it's starting to improve, meaning we're moving to the busy season, but rates are down overall for the year nationally. Now, this is street rates, so it's important that we clarify and everybody remembers that street rates and in-place rates are not the same, meaning that street rates, what they're offering to entice tenants to get in, people are dropping to entice people to come in. Now, at the same time, lots of times, though, their in-place rents are going up. So this is not revenue. And that can confuse people because they're like, revenue is up, but rates are dropping, right? How's that work? And that's what we're seeing.
Especially confuses the banks.
Yes, very much so. We're spending a lot of time with banks right now. And I think that is true to what we're seeing, where we have more specials things going on, but our revenue is up.
Yep.
And I think we're seeing that a lot. Now, in some markets, this is going to be harder than others because the street rates will be dropping much more. Other markets, street rates may have gone up, but let's kind of look at a overall here. Oh, excuse me. Overall here, national average, and kind of where we see things. So when we look at the overall top, nearly all the top metros recorded positive rate growth month over month in April. So the month before, from March to April, rates went up. Now, this was felt and led by Denver with almost 2%, all the way down to Sacramento and Austin at 0%. So they held the same, okay? Now, they're, once again, this is showing the trend of going into the busy season. All we're looking at those 2 months comparative. When you look at these metro areas and overall year over year, that's when things change. The main factors are new supply. So like Orlando continues to face heavy new supply storage in the pipeline, especially compared to the other markets. Now, when you look at that, that brings us to looking and saying where, what are we going to see in the future? So we look at that new supply, that construction, to understand inventory coming out and what that might do. So it is equal in that market to almost 9% of existing net rentable square feet. And that's under construction right now. This will continue to create headwinds for that market already challenged by weak performance. So they've already seen in 10 by 10s a 6% decrease year over year. The point of this is this market has seen a decrease. And not only have they seen a decrease, but the new supply that is under construction, so we know it will be coming, is very large. So to expect that to rapidly change or turn, we would need some very big fundamental things to change, or that should be a continuing trend. Another Florida market is Tampa that continues to see elevated development activity compared to top metro area. There are more than 2 million net rentable square feet under construction in Tampa, almost 7% of completed inventory. The metro showed weak performances in April, with same store asking rates falling 5.5 year over year. Now, when we look at, if you were to take and say under construction, this is where I think it gets interesting. So equal weight of population growth and multifamily rent growth to construction and completed inventory. We have markets that are, you have less coming out, or you obviously have markets that are more coming out. The thing that all you're looking at here, all we're talking about is the growth compared in population rentals in multifamily. So is there demand in multifamily compared to the amount of square footage of storage that's coming on? Where you don't want to be is you don't want to be in a position to where you have low weight of population growth and multifamily rent growth and high inventory coming on board. And that's where they're talking about Orlando, which is clearly it is away from the pack, where its population growth and multifamily rent growth is negative, and its completion of new stores coming on the market is extraordinarily high. In the entire nation, over 6%, the only two are Florida, Tampa, and Orlando, and Orlando is way higher. So even ones that may be high, like Los Angeles, Atlanta, Phoenix, right, Vegas, and some other ones, you're talking about 4 to 5. So they're double that. And out of those markets, it also has less population growth and multifamily supply coming aboard. Now, where you'd want to see is the opposite of that, where you would want to see high population growth, multifamily rent growth, and the least amount of construction coming on board. There we see areas like, you have areas like Denver, Washington, D.C., Minneapolis, more along the areas of the Inland Empire. So those types of areas. What we're looking at here, and the whole point of this exercise and plotting these things out, is to understand more, are these rates going to have pressure because demand has been weakened due to growth, people moving, not as much demand in the pricing for rentals, which all that shows us multifamily. It doesn't matter. Multifamily pricing doesn't mean if that goes up, storage. What it shows is demand, because people need places to stay. More people are moving, right? That's all they're looking at for that. So it shows that, and looking at that in comparison to the already low amount of occupancy and declining rates. And then on top of that, what's to come. And so we see these areas in the United States that have really polarized. And that is a very large indicator. Now, overall, when you're talking about metropolitan areas in the United States, there's none that really experienced, for April, that experienced growth, right? Year over year.
Yeah, year over year. I mean, you had most of those were 4 to at or above 8% decrease year over year on those street rates. Again, street rates is what we're talking about. And to your point, we've seen a number of these markets where there has been a very lackluster growth in population or none, with more added supply coming on. That is a really difficult cookie to crack. It's a really difficult problem to solve. And it could take decades if it ever does come back in that market.
Yes.
Oversupply, you said it from day one, AJ. The worst threat to self-storage is self-storage.
Yep.
And this is a key indicator right here showing, the decreases that are the most are in these areas that have the least amount of growth, most amount of added supply to the market. So really, really important stuff to be paying attention to. And
it is a confluence of them, meaning that, for example, if you look at areas where Philadelphia had, in the last 36 months, a percentage of inventory coming out that have already come out, it was above anyone. It was like the highest. You're talking about a 15% increase in inventory. Well, year-over-year growth annualized rents is down, 7%. So they're obviously correlated, but then you have to take into account those growth. Inventory, if it keeps up with population growth, doesn't matter, right? So if you have a 10% increase in supply, but you have a 20% increase in people that need it, it's going to go up. Prices will rise. So it doesn't matter. And this is where people are trying to match. What has happened is in those markets that had seen huge growth, and lots of times inventory was building out to those future growth. So, in 3 years at this growth rate is going to... But then with higher interest rates, lots of those growth slowed down, and yet they were already building so much to meet up, and then there's this massive gap.
Yeah.
And then that is on top of new supply that already come out. So that gets out of whack really quick. Really quick. That pendulum swings. Technology is the name of the game, and how you operate your facility and the efficiency at which you can operate will depend on the technology you use. Your property management system, what it allows you to do, and what you have access will determine the outcome of how that facility performs. That's why we go with Tenant Inc. with their product Hummingbird, because they are the best in class. When dealing with automation, when dealing with move-ins, customer acquisition process, improving my online acquisition process, they are bar none the best. So if you are looking to automate your facility or operate it in a best in class way, make sure you guys are looking at Tenant Inc. and their product Hummingbird. The link is in the description. We look at these areas and you watch these areas to understand, is this a good area that we should be looking at, investing in and buying in? And what is the market going to do? Now, I would never take any of this information as that means I shouldn't buy there, right? A deal is a deal. At some point, at some price point, it's going to be a great deal, right?
Yeah.
It's going to make sense. But
it's all about that cost basis.
That's right. But you really need to understand, though, what should I expect the market to do and give me when you look at the lease-up supply. So nationally, the amount of new supply that was delivered over the past 3 years is 8.4%. Deliveries over the last 12 months account for 3% of the inventory that existed in April. That means, it's still moving forward. There's a reason why this happens, everybody, because construction it's not a light switch. You don't flip it on. So demand is super high. Rents are going up. We start construction. 3 years later, the whole world is different. It doesn't matter. I can't stop. I'm already building. I've already spent the money. So it opens up in a totally different world that you didn't plan on.
Mm-hmm. And there's no pulling the plug, man.
No, there's no pulling the plug. You just can't stop. And that's what we see in Orlando, where you look at under construction supply. That's why that's an important metric. It's not planned. It's not, it's under construction, because that, is hitting.
It's coming.
Where Orlando is, you're talking, it is double basically the rest of the nation, and even the highest in the nation that is seen. That's the same with Tampa. Boston and Sacramento are right up there as well. Even Miami is fairly high. So those new construction numbers are ones that those can't be pulled. It's coming, it's hitting, so you know it's going to hit. But it's also even more of a problem because the more you have hit at the same time, the more they have to compete with the already operators. So it becomes a sliding scale of rates. Everybody's competing after a smaller group of people. They're doing it on price. Rates decline because you can't fill up certain sizes. That means the operators are already in existence. For them to get new tenants, they have to compete with all this new open inventory. And that's where that starts to really see that erosion. So from this data, we would expect areas like Orlando and Tampa next year, so moving into fall, right, to be worse. We would not expect to see rents rise in those markets. Now, when we look at our national averages, April year-over-year rate performance, there are two categories that were hit the hardest, and really it makes sense because this is always tends to be how it happens. It is the edges. So it's the 5x5s and the 10x20s and 10x30s pluses, right? Those drop down substantially because those are more niche, not like if you had a bell curve, they're on the two ends, right? So they don't hit the median. Whereas the smallest decreases in sizes were hands down the 10x10s to 10x20s. Those were the smallest decreases. And that seems to be pretty standardized. You see a definite change, though, based upon where you're at. So if you are in areas like New York, for example, 5x5 units actually went up. Well, that's because in New York, that is a high demand size because they don't need a lot of space. If you took that, though, over and looked at areas out west, like Phoenix, 5x5s went down by 10%. One of the largest drops in rates, right? And so in that market, 10% drop, where the lowest drop was the 10x20s. So these are the important thing to understand this is not only are the markets different, but you also have different demand for individual unit sizes. And it really will depend on where that's at, how those people consume, and what they do. That's why demand is a product-based thing that we look at. What individual size units are people taking in? If you're building or new inventory is coming on board, what is competing? And how does that work? Because you can have markets where you can have a drop in one by 6%, but then you can have another size that actually goes up in rent.
Well, and AJ, I mean, one of the perfect examples of this is an active development that we have going on right now in Arizona, specifically, where we went back to the drawing board and said, hey, this initial design that we came up with all of these different unit sizes and types, that's not going to work. We've got to go back to the drawing board and reconfigure what that unit mix looks like for that facility because, again, the world had changed in just a matter of a year and a half, 2 years, and the world we're looking at today for those unit types that we had planned, it just doesn't make sense anymore.
And we're so lucky. If it would have been 6 months prior that we would have started building, we wouldn't have been able to adapt. So we were, amazingly enough, we bought it, we got everything ready, and right before we started building, we saw the whole market changes, went through the whole slow season, and then we could see these units actually went up in value. These went down. And it was wild in comparison to what you would have thought was happening and what's going on. And we could optimize the whole entire facility. So what happened is we actually, with that, we increased the total amount of units. We also, though, we got rid of a top layer, but our drive-up units, we actually increased, but we increased the overall revenue per square foot. So in that market, rates went down. We had to adjust to the new rates that went down, but our overall revenue per square foot went up because we changed the unit mix.
That's awesome.
It's so like when you see those, when you can do the problem is if you develop and say everybody in this market wants 10x30s, and then interest rates go up and nobody wants it, and you're putting out 500 10x30s, that's when you get trapped. And that can be very dangerous. It's why I've always been against big unit facilities where we have people are like, no, people just love big units.
Yeah.
So we're going to build a whole facility of just big units.
Or
and I'm like,
any one unit type
in general.
Yeah.
Because I'm like, people change, markets change. They had that happen with one of our facilities where they built all 5x5s and like 6 buildings.
Yeah.
They couldn't fill it up. It was, they have 40% vacancy and their rate was, 20 cents a square foot, where we came and we took those buildings out, we changed all the sizes and we got up to 90% occupancy. And we over doubled the square foot rental per square foot. It was a unit mix problem.
Yeah.
So when we're looking at markets, first of all, because rents went down doesn't mean revenue went down. That's very important to understand. Also, one size unit may have a severe drop in price. That may represent 10% of the total units though in the facility. So you could have another unit size though that went up or ones that didn't. So it's really important that you don't take these things like just very standard, like, oh, that means I'm not going to build here. That means I shouldn't buy here. Those things. Now, there are some cases, for example, like Orlando, I would be very nervous with those metrics about buying anything or putting anything out.
For sure.
The amount of square footage coming on board, plus the amount that already did, and so the amount that's under construction, plus that already did, and rates, how they have dropped so significantly, I'm looking at trying to understand where we are today and how that'll play off in the future. The more percentage you change in that marketplace, the less confidence you have of today being the same. And if it's going in the wrong direction. So it would be opposite if we said population's growth, there's nothing being built, nothing's been built in the last 36 months. Well, I have a pretty strong, what I'm looking at today is probably going to continue, right? And demand may go up because the inputs that would change that aren't there. Are you a new self-storage investor and want to know what that facility is worth, what the risk is, how to underwrite it? Well, that's exactly what we do in a feasibility study. A feasibility study, we actually look at the market for you. We look at the finances, the underwriting, we show you where the upside is, the downside, and all the risk. That is actually what you can provide to banks to get capital and investors. It's a big worksheet which most banks actually require. So if you want to know what a storage facility is worth that you're looking at, come to us, follow the link in the show notes, and we will tell you. We're in a market cycle, everybody, that we're going back to normal. We didn't used to be able to just buy anywhere and rates everywhere went up and occupancy went up. They were subject to natural market forces and individual markets acted individually. That's where we're returning now. We have markets that will perform better and others won't, and it will be back to normal supply-demand bell curve. And we have to operate within that. And so I don't even think that that's a bad thing necessarily. Of course, we always want occupancy and rents going up, but it goes the other way, meaning we're going to hit this, and then there will be this huge gap in development, and then it'll turn and go the other way, where now these markets are oversupplied. So in 3 years, you could be in a position where Orlando is now undersupplied. Like it's now we're going 3 years out from that point, there's a huge supply problem in Orlando because everybody stopped building because rates and everything went down. These are cycles that happen. You have to understand where you're at in that overall supply and demand curve.
No, you're exactly right. And I think there's a big question on a lot of owner-operators' minds right now is, if we're in those markets or we're in markets where we've seen year over year those decreases in street rates, how do you compete in those markets where, people aren't hitting those expected, revenue targets. They're not hitting their quarterly objectives. They're not hitting, occupancies, those different things. We've had a number of calls with store local partners and different things. And consumers are smart. Consumers are a lot smarter than I think a lot of people like to give them credit for.
Yep.
In a lot of instances, there's a number of them out there that they know what's going on. They know that they're going to get into a storage facility and they're going to get this introductory rate. And in 3 to 6 months, they're going to get their rate jacked up a ton. It doesn't matter what storage facility they go to. And some of the operators have really gotten good at really just dialing in on that level of customer service and providing that to the consumer up front and saying, hey, yes, this is, and prefacing that this is our introductory rate. This is our promotional rate to get you in. That way, when the customer does get that rate increase later on, you're not seeing as much of the mass vacancy as in move outs and those things as you normally would. I know a lot of people have gotten a lot less aggressive with rate increases and a little more strategic there as well, to really help maintain occupancies. Because you have the other side of the coin too, where not only do you have this decrease in street rates and the need to make up that revenue over time to hit those targets, and not only is it going to take a longer time, but now you have the added cost and that increased cost of customer acquisition, just operational costs in general. There's kind of a double edge to all of this where it's gotten, like you said, it's a lot more competitive. We're getting back to a normal. And I think a lot of operators are really struggling and trying to figure out, okay, well, how do we combat that? And how do, like, if street rates continue to go down, or if they don't continue to rise at whatever expected rate, how do we really compete with, one of the facilities down the road that's in the race to the bottom? And that's really it. I mean, providing that customer service, providing a great facility, a great product. I mean, we'll keep pounding that drum day in and day out. And on top of that, I think to a degree, chasing rates can be kind of like chasing unicorns, where at the end of the day, people are going to make buying decisions based on their level of comfort and how well they like the product and the service versus the price. If I'm $10 higher than Bob's down the road, I wonder if there's a Bob's storage out there that we just keep smoking on the pod.
Every time, just like Bob, poor Bob's out there, just like, oh.
Bob, sorry, man.
Sorry, Bob.
But anyways, if you've got another storage facility down the road that's cheaper, but and we're $10, $20, whatever it is, higher for that same unit type. I mean, if we're providing a great and immediate customer service experience, providing a great product through and through, great user experience, all of the things that people are really looking for in a storage unit, all the things that our ideal tenants are looking for in a storage unit, that's really how we're going to compete with those things, and really having the expectation that, if we do decrease those street rates to a certain level, it is going to take X amount of time more to get those revenues back up to a certain point, but it's all the ebbs and flows of the market. Like you said, it's very cyclical. It's doable. And again, these are just the street rates. We're not talking about the in-place rates and how we're managing those over time and able to, you're just showing on the webinar today for self-storage income, showing that gap between, okay, this is the market rate and how much is decreased. And here's actually how much our revenues increased.
Yeah.
It's total night and day difference, which is, it's amazing. The revenues are way up, street rates are way down.
And this is why we say it's a business. Treat it like a business.
100%.
You have products, right? So this is why I hesitate with some of the stuff, because we don't look at it like the market's doing this and that just means we accept it, or that's what happens, right? The market. We understand the market can break us, but we understand the market doesn't make us. So it's like, okay, we got to figure out ways, what units are good, what are not, how are we positioning? Are our people selling right? Is that what's happening?
Exactly.
You should be looking at your whole sales process, customer acquisition process, because we've had times where we lowered rates that was by far and away the lowest in the market, and we weren't having acquisitions, and we're like, there's something else going on here. And it was. It had nothing to do with the rates.
Yeah.
A lot of people think that they have lower rates, but they're not acquiring people, and it's because the market sucks, when it's not. It's actually them. They're not performing. They're not executing. Something's broken in that process of customer acquisition. It doesn't matter that your rate was lowest. You're still not getting it. In fact, if you would have had a better customer acquisition process, it could have been higher, and you would have had more move-ins.
Well, and one of the ways we identify that is the amount of leads. We're tracking all of these metrics at the facilities. And if we're getting a bunch of leads to a facility and those aren't getting closed, it has a really low closing ratio at that facility, then clearly there's a problem, right? There's a problem in the sales process. And I'm going to say 90% of the time, if not more, it is a problem with the process or the people involved in that process. It's very rarely just, it's the market.
I couldn't agree more. So everybody, remember, although we're going through this, there's lots of different ways. First of all, we are moving into the busy season. This is a 1 month thing. We could literally be into May or June, and they could say, oh, rates are up 6% in June over last year in June. This is a snapshot of just 1 month.
For sure.
And things change, right? So year over year for June may be up.
It is promising seeing the month over month increase.
Yes, the month over month increase. That's really, really good.
And we are, from our portfolio that we have now, we are seeing that that busy season this year, which is absolutely fantastic.
Yes.
I know that's been a huge question on a lot of operators' minds.
We are
saying,
seeing
"Hey,
hundreds of
seeing?"
rentals a month. Like
Yep.
we're seeing it.
Yep.
And so that occupancy is coming up. We're getting it. We're nailing things down in. And there's ways you can do it. The rate doesn't equal revenue. It doesn't at all with us. We have facilities that we drop to entice people in, and our revenue is substantially up, not even kind of. So that's also an important thing to do. That's why in storage, though, everybody, simple, it's a business, not just an asset that goes up and down with the market. Treat it like that, and you will be rewarded. With that, hope that helps everybody.
Heck yeah. Soak it in. Get out there. Make things happen, guys.